Good morning and welcome everybody. We are so pleased to have you with us today on this Wednesday morning. ERSA is very proud to announce that we've got this really exciting project that we've been working in conjunction with the German Development Corporation as well as the International Food Policy Research Institute. And we've got a really exciting sequence of events which will be unfolding over the next few months. So this is the first one and we are very pleased to have you with us. This set of events will be looking at all corners of economic policy and looking what constraints we face now after this COVID crisis and where it leaves us and how can we build ourselves back given this position we're in at the moment. So our first event, we are specifically focusing on the monetary policy leg. And as you may have seen, we have a really exciting lineup of guests who will be discussing some really great research we have been doing. So the research has been conducted by Professor Nicola Viegi in conjunction with Tumisang Loate and Ekaterina Pirozhkova, forgive me if I've said your name incorrectly, all from the University of Pretoria. And today chairing the event will be Konstantin Makrolov. Unfortunately, Chris could no longer make it. And we have the discussants Mamokete Lijane from IFPRI Group and Gina Skuman from Citigroup, and also joining us is Matthew Simmons. So without further ado, or before we get there, let me just give some housekeeping rules. This is a discussion, so we hope you enjoy the more casual approach we will be adopting today. And we do encourage as much participation as possible. So to all our attendees there, please do engage with questions. You can use the Q&A feature at the bottom of the screen, or if you'd like to raise your hand, please let us know and we'll give you an opportunity to voice your opinion. Thank you. And over to you, Konstantin.
Thank you, Margot. Thank you very much. It's great to be here. Let me start by apologizing for Chris not being able to be with you this morning. He has been held up in an important meeting and he may join a little bit later. Let me also say that this is not a meeting about monetary policy decisions in the next MPC meeting or the following MPC meeting. This is a general policy discussion based on the paper produced by Nicola, Viegi, Ekaterina, and Tumisang, which is part of this project. Before we start, I want to use this opportunity to introduce the new Director of Economic Research Southern Africa. This is Matthew Simmons. Many of you know Matthew very well. Matthew is I don't want to say a famous civil servant, but a really accomplished civil servant. He was a DDG in the National Treasury. He managed both the budget office and public finance, and then he spent quite a bit of time at the International Monetary Fund. We're really excited to have Matthew back in South Africa and as Executive Director of Economic Research Southern Africa. Matthew is going to come at the end of the webinar to talk to you about the next 3 sessions. And the topics covered in the next 3 sessions, as well as the panelists. So let's start let's start today's session with Nicola giving us a short overview of his main findings, the main findings from the paper. Nicola, over to you.
Thank you, Konstantin. Now, this paper comes out of sort of on a need to take stock of what has been the experience of monetary policy in South Africa, what are the challenges going forward. Therefore, more than is very much a research agenda for us. The way we wrote it was very much what is that we need to understand better about how monetary policy works and how we should think about monetary policy going forward. Because the world we are going to face, actually in the last 10 years, but the world that we are going to face going forward is significantly different from the past, and therefore we think that everything should be reanalyzed and we should think harder about whatever the economic policy of the country and what are the big constraints to monetary policy. And then we wanted also to put monetary policy in a context. I think it was also a sort of a response to a South African debate about economic policy, as if there were some engineering instrument that can achieve everything, that everything is about only political will, is not about actual constraint. But we wanted to put instead monetary policy in the context of what are the constraints that monetary policy is going to face, is going to face. And therefore, you can understand how monetary policy works only if you understand how the world around it is evolving. And especially we're looking at three things. One, we need to understand how the external environment affects South Africa and affected and constrain the ability of monetary policy to achieve its objective. Therefore, start large from the world and then look at how the lack of economic growth is interacting with monetary policy and affect how monetary policy can work and should work. And finally, we were looking at the relationship that will characterize monetary policy in South Africa for, I think, at least for the next 5 to 10 years, that is a relationship between monetary and fiscal policy. So how fiscal policy is affecting or constraining the ability of monetary policy to operate. Therefore, we were focusing specifically on these three elements: the external factor and the connection between the South African economy and the rest of the world, the lack of growth and what is the role of monetary policy in this context, and the relation between fiscal and monetary policy, how fiscal policy has become the big or the accumulation of fiscal debt has become the big weight on the big constraint to monetary policy going forward. Then we need to think about what this means. This one very much what we try to do. It was also, the paper is also, if you want, a defense with inflation targeting as a pragmatic response to uncertainty. There is a lot of in the paper about that we have to understand the monetary policy in a context of, especially in emerging countries, in a context of uncertainty, where you need flexibility to respond to a situation that is always changing, is always risky. But you can have flexibility only if you anchor this flexibility to some long-term objective. That's why inflation targeting, only Argentina left inflation targeting. Argentina is not an example to follow. But a lot of emerging countries actually found inflation targeting. It was thought as a model only for developed countries. Actually found the inflation targeting that instrument that is flexible enough to respond to this continuous risk and uncertainty that the country faces, because they anchor to something sort of medium long term objective of stable prices around which you can organize also short-run responses to all these difficulties: fluctuation in capital flows, an economic growth that is not going anywhere, fiscal position that is extremely risky. All these can be dealt with in the cost of inflation targeting if we really realize what inflation targeting is. It's not an ideological choice, it's just a pragmatic response to what are the limits of monetary policy and what monetary policy can achieve. And that one, I mean, to give you the sort of the big theme of the paper that we can maybe go through in the discussion with all of you.
Thank you, Nicola. Thank you for this quick overview. I think it will be useful to take a step back and ask what have we achieved in terms of monetary policy? What has worked and what hasn't worked? And it will be useful to hear Gina and Mamuketi's view. Just looking at the last 10 years, what is their view? What are the kind of the successes of monetary policy, and what are the things that haven't worked so well? And then we're going to move into dealing with the three elements that you identified, Nicola. Gina, over to you.
Yes, I mean, I don't think this is a very contentious issue. When we look back over the last 10 years, we realized that as economies became more open, they became more vulnerable, especially to global shocks. And as a result of this, they were able to introduce inflation targeting and respond to these shocks while also looking at domestic issues. So flexibility is the absolute key here. I completely agree with the prof. You need the flexibility because By targeting inflation, especially for a country like South Africa, where I would argue inflation is really just toxic, given how much the consumer adds to GDP and how much disposable income adds to consumption. It reduces investor uncertainty. It helps to predict interest rates. It also, and I think this is very important, as we've matured with inflation targeting, it's helped to anchor inflation expectations, because we've seen an introduction of a range. Then we've seen the SARB start to use communication as a much more powerful tool. We've then also seen the implicit target of the range move to a lower 4.5%, which of course has helped with some other factors in anchoring inflation expectations. And I don't think I need to describe why anchored inflation expectations are so useful to an economy. So that's my quick general snapshot of why I think it has worked up until this point.
Excellent, thank you, Gina. Katie.
Yeah, so I agree with Gina and I agree with Nicola that the overarching positive impact of the way monetary policy has been conducted, which did come through in the GFC, and I think was also evident now with the COVID crisis, is that monetary policy has served to anchor long-term inflation expectations in a very strong way. The SARB is highly credible, and I think that's been one of the factors that has anchored the currency to some extent. The currency still is very, very volatile. But because of the presence of the SARB, there's always like the self-limiting dynamic that comes through in how price adjusts and nominal prices adjust in the economy. So, by virtue of having taken out a lot of that inflation uncertainty, I think it's opened up the space to really discuss the factors that actually matter, which is the real variables in the economy. And that's priceless, because if you had a lot of noise on the nominal side, it would make it very difficult then to identify sometimes where the real issues are in the economy and in how the economy is performing. So I think by moderating the nominal variables and just making clearer what is happening on the real side, it cleans up the conversation to a large extent, which is something that can often get lost in economies where you have massive variability in inflation.
Thank you, Katie. I think we have achieved, we have reduced inflation volatility, we have reduced inflation expectations, and it hasn't been only kind of monetary policy, there have been various other factors. But I'm wondering, if we look in the global context, have we done enough? So if you look at our inflation expectation, they're still much higher than in other emerging markets. Should we have done a lot more in terms of lowering inflation expectations? Katie?
I mean that's an important question, right? That came out somewhere in the early part of the inflation targeting. Even when the target itself was adopted, the intention was always to lower the target at some point and bring it closer to that of our trading partners. Of course, when we ran into growth pressures, then we sort of like pulled back a little bit from that objective, and now our inflation tends to be higher than that of our trading partners. But I think for South Africa, and I mean, this speaks back to the point that Nicola makes in the paper, that when your growth is low, it starts to complicate the job of monetary policy. So because we've had low growth, and there is a sense that there is a sacrifice ratio, at least in the short term, between getting inflation expectations lower and short-term growth, there's a sense that we cannot afford that output loss that we could potentially incur in order to get inflation lower. So I think over the long term, it's the right objective to expect that at some point we will take inflation expectations lower, but also there is the real political economy reality that you can't do that when you're sitting with a potential growth rate of 1%, because then should there be a sacrifice ratio and you don't quite know what it is in advance, the economy cannot afford to incur that, and that would then be a problem from a political economy perspective.
Yeah, Constantine, from mine, I'll quickly jump in here to add to that. It's exactly what Mama Casey said. We are still dealing with quite a lot of inefficiencies in this economy. And inflation is the function of inefficiencies. So effectively, you could argue that the inflation we're currently seeing, as lower as it is still being driven up by those inefficiencies, even though it's being driven down at the same time by the demand or the lack of demand for inflation. So effectively, this would go hand in hand with a view on how more efficient is your economy getting. And therefore, you can start looking at things such as potential growth, but obviously potential growth leading to better efficiencies in the economy, because then you're in a better position, of course, to be more competitive, and naturally your inflation would be able to be anchored at a lower level.
Thank you, Gina. Maybe you can expand a little bit on what you mean by efficient. I mean, is this about network industries? Is this about something else?
It's exactly that. I think it's about looking at supply chains and looking at how these cost push pressures move through those supply chains. I mean, I'll give you one very quick example. And I know anyone who's been listening to me for the last couple of years, they'll already know this hypothetical anecdotal example that I'm about to give. But if you look at the retail sector, for example, especially the food retail sector, you'll see that, yes, we still get hit by exactly the same type of soft commodity price cycles as we have in the past. And typically it translates into almost the same type of producer food inflation that we've seen in the past. But what's changed here is that for all the inefficiencies in the supply chain that are being added to the soft commodity prices, such as electricity tariffs, such as distribution costs, etc., a lot of those then do not filter through to the consumer because of market concentration dynamics between your retailers and then, of course, your producers. So there are some supply chain features in South Africa that I think are very unique to this economy and are obviously helping to lower that pass-through. But it doesn't mean that it's happening because we've seen huge efficiencies through the chain. In other words, there still are inefficiencies, but they're getting blocked up in the chain somewhere. And that, of course, does not do a lot to enhance your growth potential.
I suppose the other area as well is administrative prices, and you referred to some of them, but it's generally how government set prices move in the economy. Nicola, you wanted to come in earlier.
Because we otherwise become the paper.
But I want you also to comment on the sacrifice ratio that Mumuketi was referring to as you respond to the question.
No, exactly. I don't want to be too elegiac to the South African Reserve Bank as everything. I think, for example, one of the things we notice in the paper, we notice in the data as well, is a sort of this uncertainty about what are the structural relationships in the economy. This uncertainty about the shocks. It made the bank move more and more towards communication, less and less for a long time, or using the instrument. There is a sort of risk-averse attitude on using the instrument and try really to move the communication in the direction of be more precise on the 4.5, etc. But it's definitely after the global financial crisis, there is a sort of a movement of the instrument is less and less, and more uncertainty about what are the structural relationships in the economy, how they are evolving. And therefore, that one is also one of the limits to monetary policy. One of the limits to monetary policy is quite high level of uncertainty about the structural relationship, what the sacrifice ratio is, how should we think in terms of Phillips curve monetary policy, or we are always one step away from inflation going out of control. This level of unemployment is, can we imagine it as only as a structural future, or who is responsible for trying to reignite the economy? Therefore, I think these are all discussions that actually I think is worth having openly, because we cannot rely only, on sort of preconception about how this economy work. Especially, for example, this issue of the labor market, and it's fundamental. When you have unemployment 30-80% is fundamental. This will put pressure on the political economy, on the monetary policy. For this reason, I think it will be unwise to spend political capital on try to reduce the target, for example, because you have to spend political capital in a situation in which it's difficult to, in a situation of unemployment at this level and an economy at this level of stagnation. Therefore, if you want to use political capital, you have to spend it in something that can give you benefits straight away. That you can show that it actually moving. It probably this is probably the fiscal side is probably where the political capital is more important, because actually I think now is becoming the biggest constraint. Consider simply the effect on cost on capital on the structure of the debt. Your slope of the yield curve, how much is more costly investment in South Africa relative to other places, because of how much the government is borrowing, especially at the long term. These are, elements that can have an effect, an immediate effect, a quite significantly expansionary effect. If we can reduce the risk premium of the country, if you can reduce the slope of the yield curve in a significant way. If you do that, then you can have that expansionary effect and you can spend political capital on that.
Thank you, Nicola. I mean, this is quite a useful transition into one of the factors that you identify, one of the important factors that you identify in terms of the future of monetary policy. But it is also a factor that has been driving monetary policy over the last couple of years, and this is the fiscal issue. So, if you are to comment on monetary policy in the context of fiscal policy, do you think that the responses were correct? And what do you think the responses should be going forward? What are the implications, rather, for monetary policy going forward?
The response is correct in the sense that it's a defensive response. It's a response that in a situation you have at least one of the two policy to remain anchored and stable. Somebody has to give stability. Monetary policy gave stability to the country for the last year. The problem remains. The problem is how we get out of the situation of debt accumulation, and what is the role of monetary policy in this context. I think monetary policy can help in the context of a very strong fiscal plan. Therefore, there is two ways in which monetary policy can be used to solve the fiscal issue. One is to monetize the debt, and there is a lot of great crazy ideas going around about this. Therefore, simply you give up, or you are in the impossibility of control the fiscal dynamic. Therefore, monetary policy is forced to intervene and monetize part of the debt. The other one is to provide, if you want, the right policy mix in which you have at the same time a fiscal consolidation. The monetary policy should help the fiscal consolidation by providing the stimulus necessary to minimize the negative effect of the fiscal consolidation on the economy. Therefore, if you want a policy, if you want the saving of the country, it has to target to go back to be responsible, while monetary policy can provide the necessary stimulus by lowering interest rate, and therefore fiscal policy control the consumption side, and monetary policy help by lowering the interest rate to provide fuel for investment and growth. Therefore, it's very important to have these helping each other in the process of fiscal consolidation. Obviously, this one can work, and this is credible only if the process of fiscal consolidation is credible. And therefore, if you can tackle what are the big dynamic expenditure that are not giving you any growth. One of the other things that is in the paper, from 2014, fiscal expansion in South Africa are contractionary. Therefore, not only the they haven't helped in the process of getting out of the crisis after the global financial crisis, but actually have worsened the situation. Because the increase on the long-term interest rate and increase on the risk premium has been, overriding whatever positive effect was coming by increasing fiscal policy. Therefore, there is nothing the fiscal policy can really do much. Therefore, monetary policy can help only if we have a credible fiscal plan. That is, a sort of, if this is go through the paper, you can do everything. As long as you have these strong long-term fiscal and monetary anchors that provide stability in a situation that is uncertain, because the world is uncertain and because the structure of the economy is uncertain. But we have lost one anchor, the fiscal anchor. We need to get it back. And monetary policy can help, but not financing the debt, but providing the necessary stimulus to counteract the contractionary effect of fiscal policy.
Thank you, Nicola. We're going to return to the issue of monetizing debt and quantitative easing. But I want to ask Gina and Mamuketi, one of the big things in the paper is the issue of what determines the level of risk premium, and the paper argues that it is debt sustainability, and then it's the issue of volatility. But that also links to how we think about neutral interest rates, and establishes a direct link between fiscal policy decisions or fiscal sustainability and monetary policy. Whenever we think about monetary policy, at least in the world of central banking, we do it in the context of a neutral interest rate. So a policy is accommodative if a neutral interest rate is, if the actual rate is below the neutral interest rate, and it is contractionary if it is above the neutral interest rate. I'm simplifying, but this is the essence. So I want to hear your view, whether, how we think about this measure of the neutral interest rate in the South African context, where we've got, maybe not at the moment, but generally high dependence on foreign savings. And whether the normal prescription, which is that when growth is low and potential growth is low, the neutral interest rate decreases, is valid for South Africa, or whether in the South African context, the key determinant of the neutral interest rate, or the two key determinants, are effectively fiscal policy, as it drives the risk premium, and global interest rates. So I'm going to start, Gina, maybe you can go first, how you think about neutral interest rates.
Well, I'll give you, I think it's pretty straightforward, right? A neutral interest rate or national rate of interest must be linked to potential growth. To put it far more simply, it's an economy's demand's ability to pull inflation into the system, right? And then that in itself will start to determine where, of course, your neutral rate should be and how you should be moving around it. And effectively, if it leads to higher inflation, then eventually, well, let me rather take a step back before I hand over to Mamuketi. I do think that, and maybe this is also a very specific dynamic to South Africa, it's also not a straightforward thing. So in other words, let's use the last 10 years in South Africa, and I'm going back to the argument about inefficiencies. As South Africa's potential growth rate came down, that in itself led to inflation, with all the inefficiencies in the system, and a lot of that being obviously administered pricing. But obviously, over a long enough period, that starts to diminish and reduce your demand potential in the economy, to the point where that then takes over, and it has a much stronger anchor pull, downward push on top of those cost push pressures as such. So inflation rate will then start to reduce, which I believe has happened to South Africa. But again, it doesn't mean that it's reduced because you're more efficient. It means you've reduced your inflation rate because the inefficiencies has reduced the demand potential in the economy. So I do think that it is very, very strongly linked to potential growth.
Thanks, Gina. Mamuketi.
The question is actually quite complex, because like you said, traditionally you would think higher growth, higher required rates of interest, or at least achievable rates of interest, and therefore higher R star, right? but it doesn't really work like that in reality. So, you know, for an economy like ours, obviously there is a big link to the global economy and to the global environment. And I think that's one of the points that Nicola makes quite strongly in the paper, that at the end of the day, for a small open economy, which is reliant heavily on external capital to fund itself, then the external environment becomes the critical, if not in some respects, the most critical anchor of whatever your policy rates are. Your base case view has got to be about, you know, what things look like before you add whatever it is that you're doing domestically. So I think our star is highly dependent on what is happening globally. And, you know, you see that coming through, for instance, when you think about the global real rate of interest, which is maybe the proxy's G3 real rate. And then you talk about MB, and MB is a function of flows in and out of emerging markets, if you look at it on aggregate to a large extent, and overall growth environments within the emerging market or non-developed space overall. So before you even start to talk about what is happening in South Africa specifically, you have to take those two factors into account. And I think that also speaks to the fact that over the short term, our star, or the real rate of interest, not the sustainable real rate of interest, but the actual real rate of interest that is the ruling rate of interest for capital for an economy like ours, is already quite volatile, because those two variables that I've mentioned are themselves not very, very stable over time. And that speaks to the idea of global capital flows, capital flow volatility, etc., which is such a big factor for what it is that we are able to run in South Africa before you even think about what is happening in South Africa specifically. So this now, you know, creates that drift between the idea that, you know, real rates of interest that linked to domestic growth, suddenly a bigger part of it and a bigger part of the volatility becomes about what is happening outside of South Africa to a large extent. So, you know, and that's one thing where I think, you know, the SARB has maybe not been as responsive as maybe what I would have liked around that, or at least the communication hasn't really been clear about how monetary policy settings in real time relate to this huge thing that can move, you know, 400 basis points from one year to the next. So, you know, for me, that's one of those key questions. And then the other thing is, then when you look at the domestic growth story, again, you know, the real rate of interest is, you know, the relationship is turned on its head. Actually, the higher your growth, the lower your real rate of interest, because the lower your, you know, your credit quality, the higher your credit quality, your ability to repay debt, etc. And when growth expectations drop, you know, you get the reverse. So even in that context, the relationship is not as straightforward as would be in sort of like old economic orthodoxy, so to speak.
Thanks. Thank you, Mama Katie. Nicola, I want you to come here as well and comment on the neutral interest rate.
No, exactly. And I think the last thing Mama Katie said was perfectly right. And I think that's why we put a lot of emphasis on this element of risk and uncertainty, because actually is a price. When we talk about buffer stock, when we talk about that the economy overall, the central bank, the fiscal authority, but the economy overall need to build buffer stock to reduce that riskiness. That actually is really the things that move in your natural rate. That is affected by all these external elements or riskiness. That is really where I think we haven't worked enough to really think what this means and what this means for an economy, how much it affects an economy in South Africa. I'm old enough to remember, definitely the eldest here, to remember the Asian crisis. When the Asian crisis arrived, Asian countries after the crisis interpret the crisis really as okay, we can have access to international capital market is important for our investment, but to do that, we need to do it in a position of strength. They started to save. Therefore, they have a big stock, the biggest increase in accumulation in reserves and savings, and then all the movement towards sovereign wealth fund that became this buffer stock. Therefore, if capital come in, I invest outside. If capital go out, I bring the capital back in myself. Therefore, worrying very much about this element. We need international capital because bring investment, knowledge, know-how, increase our potential growth, etc. But we don't want to be affected by big short-run movements, by fluctuation on the global financial cycle. And therefore, we need to build up instruments to reduce this riskness. In South Africa, we never really. I see always a discussion that is quite inward in this sense. Therefore, that what is that we need to minimize this external uncertainty, to increase our potential growth while reducing the risk attached to it. That is, I think, where the paper, I think, is spent quite a lot of time thinking about, because otherwise sometimes we become too much concentrated on one, what is the natural rate?
Nicola, can I just come in there quickly? The one thing is you talk about buffers, etc., but there is a cost attached to building up these buffers.
Sure.
And so when we think about it and you say, okay, this is what the ideal world looks like, but the transition from the current world to the ideal world is not a straightforward path, and it involves quite a lot of costs. Sure. Political costs, like you mentioned before, and maybe that's what complicates the issue. If you think about the sort of political fallout for the fiscal consolidation that we saw in the 90s and 2000s, and even the introduction of inflation targeting as a monetary policy framework, and what that has actually meant in terms of the sort of pushback to that maybe to some extent we can ascribe the past 10 years to, because definitely the pushback from those kinds of policies probably informed the permissiveness that we saw in the past 10 years. So there is a certain cycle that's played out in that area as well.
And I'd like to also pose a bit of a question to the Prof, just in terms of your paper and thinking about, what can be done in the, let's call it the next 5 years or so. What is your take on South Africa's balance of payments current account here? Because, it's not like it used to look, but at the same time, and I'm not talking about the huge surpluses we've been through very recently. I think it's quite sensible and reasonable to expect that to fall, once again into a smaller deficit, but it's going to be smaller than what it was in the past if your potential growth is on.
No, I think that one is one of, that's why COVID is a change, is a structural change that allow us to rethink a bit also certain model. Because in some sense, yes, there is an opportunity to move away from a sort of consumption and then non-traded and externally financed growth to a model that is more based on the productive or the development of the productive capacity of the economy. Therefore, once if we now we are therefore that is where I think we are there is an opportunity in some sense to redefine what the growth model is. And Mauket is absolutely right. Obviously, this has got a cost. I don't know what the alternative of this path is. Therefore, what is the alternative of a path of building up buffer stock, reduce uncertainty, and therefore increase the potential growth, therefore the natural rate of increase, but reduce the risk? What is the alternative to this path is not clear to me, because we cannot go on like we did in the last 10 years, because we don't have any more room, both either fiscal or monetary, to operate. The alternative can be a sort of a closure. That confronted with the problem, we decide to, finance a fiscal policy with monetary policy, or increase the barriers, disconnect from the world because the world is so risky. I don't see what are the alternative paths to that. I'm not sure that that I can see. Yeah, there is alternative path, but I think the cost is higher.
Thank you, Nicola. So we've spoken about the relationship between fiscal policy and the need to consolidate and then have accommodative monetary policy. Otherwise, we're sitting with the situation where even if monetary policy lowers short-term rates, long-term rates are high and the yield curve is quite steep. The one thing that we haven't spoken about, and Nicola referred to briefly, is quantitative easing, which again links to the relationship between monetary and fiscal policy. We've been criticized during the COVID, last year, that we haven't deployed quantitative easing policies. I think one of the questions on the chat refers to that as well. And so I want to know from you how you view quantitative easing in the South African context, and whether it is something that we should have done last year, whether it is something that we should be using more regularly. And I want to start with Mamoketi, your views on quantitative easing in the South African context. I mean, the thing that has changed from the global financial crisis is that during the COVID crisis, we saw a lot more emerging markets using their balance sheets to influence rates. And so it is very interesting to hear your views from where you're sitting and you're monitoring global markets and other emerging markets. Mamoketi, over to you.
Yeah, I mean, this is one issue that I think, Nicola spent a few paragraphs on his paper actually looking at, and I thought he answered it quite well when I finally pieced all the different parts together. So this idea that, that quantitative easing, in the way it was used as a crisis response mechanism, is probably appropriate in the context where the rest of the system is reasonably credible. So if I look at last year when the SARB took the decision to start buying bonds across the curve, it was in a context where there was a need, there was an understanding that the program was temporary, that the SARB itself was highly, highly credible. So they were able to expend some of that credibility, the capital that they have, executing this program, because there was an understanding that it's probably not going to be a permanent thing. So the question is, what is permanent and what is not, and when have you done too much and when have you done just enough? So I think if you look at then the discourse around, quantitative easing or the purchase of government debt by the state, even though the SARB said it wasn't QE, doesn't really matter to me. It's the SARB buying bonds. Was that the SARB was very, very keen to communicate consistently that this is not QE, this is not QE, this is not a similar program like what you would see in the US, for instance. And I think that then anchored expectations around that. So I think the fact that it was temporary, it was an emergency response to a situation that was apparent and clear to all market participants, made it quite different to this idea that the bank is monetizing debt. So you've got to manage that quite clearly. Where I think the paper fell a bit short for me was around the use of alternative tools. So Nicola spoke a lot about monetization. He spoke quite a bit about the fact that, central bankers are going to have to come up with different tools. He mentioned macroprudential tools at some point. And my big criticism, to some extent, of the SARB, and it's not a criticism so much as it is an observation, is that beyond just the interference in financial markets, which the QE was, I thought the SARB didn't do much in a real economy context. So what are the other tools that the SARB could use? And I look at the macroprudential tools and I say, okay, fine, those are normally used to manage risk if you have bubbles. But what happens when you have imbalances that are on the opposite side? So there's a certain asymmetry there. So beyond just like purchasing bonds, what about the rest of the toolkit? And is there any discussions around that?
Constantine, can I add to that? So I mean, I genuinely agree with Mama Katie there. I think that what was very difficult about doing this last year was that the sense of fiscal policy last year had not improved, I guess, as much as it has right now. When you stuck looking at fiscal policy, not knowing actually what the next 12 to 18 months will hand you, it's very difficult to do more than just, let's call it financial stability QE. But I do think and agree that this is definitely a trend that we are in now with other emerging markets. I mean, even the IMF, the LSI index has shown that for sure, a lot of these quantitative easing attempts by emerging market central banks, whether it be, more than financial stability or just financial stability, whereas we all experience just as much stress in our markets, in our local markets, as that of the global financial crisis. The period of that stress was so much shorter this time because emerging markets have matured, obviously, in what they can do under those type of crisis conditions. But where I do think we are very lucky and have a very clear advantage, and Mama Katie did touch on this, is that we have one of the most highly credible and independent central banks. But one additional part of that is, anyone who was getting questions last year about, this financial stability QE and what was going on in South Africa during the crisis, you would have had to take a lot of questions as to the political economy. So in other words, how protected is the SARB? And when I say how protected is the SARB, the recent renewal of Lesetja Kganyago's second term quite early on, together with elevating some of the MPC members into deputy governor status, gave markets a sense that the SARB could control this depending on how they viewed fiscal policy. So it makes it more difficult when the SARB or the MPC is that much protected, so independent, to go down a path of debt monetization. And in addition to that, then, I've always said when it comes to QE, however we want to define it, I mean, if you don't have any fiscal credibility, it's always then going to show you whether a central bank is endorsing it or not. To endorse QE under fiscal policy that is questionable and highly uncertain, that tells you a lot about the central bank you're dealing with. So I do think the SARB was indirectly sending us a lot of very strong signals to say, well, we're doing a little bit more than usual. We've always kind of done it. We're just doing it in a much bigger way. But this is about the limit that we're getting to. We're not comfortable to go further than this, not right now.
And can I also just come in there, just
yes,
before Nicola responds? There's the issue also of FX volatility, which is linked to one of the issues that he highlights in his paper, which is around capital flow volatility. And he makes the point that this is a permanent thing. So capital flow volatility is not going anywhere. It can have an impact in the real economy, and maybe there is a context in which you as the SARB, you need to think about what a permanent solution to this as a problem is going to be. And that links back to Ashok's question, I suppose, in the chat, where he says, you've got this FX appreciation at the moment. Is it desirable? Is it not? What should the SARB be doing in response? So, that beyond just the rates and monetary policy and, cutting the repo rate, etc. There's all these other things that are happening outside that are quite permanent, that are going to require that the SARB applies its mind, which then comes back to this whole thing about what is your toolkit beyond just the repo rate?
Thank you. Nicola, just before you come, excellent point, Katie. I just want to highlight what Gina said, which I think is quite important. For monetary policy tool to be effective, one, you need the bank to be politically protected, but two, you need the credibility of other policies, macroeconomic policies, and in this case, fiscal policy. Otherwise, some of these instruments are not credible and not effective. And the other thing that you've highlighted, Nicola, is the issue of capital buffers. So these also increase both the credibility and the effectiveness of monetary policy decisions. So when you don't have them in place, then it's a lot more difficult to do things. I want you to, we need to return back to the quantitative easing issue. And you have to tell us what your view is. But one of the things that the way I look at QE is that there's three differences or three versions of it. And the first version is kind of the strict QE, which is largely about changing the composition of balance sheets in the economy in order to improve the transmission of monetary policy. So this is not about monetizing debt. It is not about anything else. It is about the monetary policy transmission mechanism. And it is justified only when the mechanism of the transmission of monetary policy is not working. Then you have two versions which are not really QE. The one is temporary monetization of government debt, and the second one is permanent monetization of government debt. So as you think about these three versions, I want to ask you, how do you think about QE in the South African context? Maybe over, whether it is something that should have been done, and how do you think going forward as an instrument of central banking?
See, all right, I think QE is interesting in this sense. It's a demonstration that the more the overall economic policy framework is credible, the more leeway you have to try innovation in policymaking. For example, Chile, they monetize the debt. Therefore, without any sort of significant, actually, they declared that this increase in debt, given the COVID, can be easily financed through quantitative easing. They could do it without losing, because they have an overall framework that is incredible. Inflation at 2%, interest rate close to the zero lower bound. There was no doubt in which way QE was used for what. The possibility for South Africa was more limited. You had to intervene when you have this big shock, making clear this very strong separation between this intervention and any quantitative easing in terms of financing public debt. Why this limit? Because the overall system, the overall relationship is still not this. But there is a lot of instruments. Why we don't use more reserves? I'm not particularly clear to me in the issue of capital flows. Why we don't? There is the issue. Yes, definitely there is all the space of macroprudential policy, but also microprudential policies. Therefore, how do we use it? Not only to minimize the to minimize the risk, in the banking sector. Sometimes, for example, the macroprudential policy, we have other work. Maybe we are using it too much. Actually, we are relation to what the structure, the need of the economy is. There is quite a very strong emphasis to get to the rules, the international rule, quite fast. There might not be what the country requires, what the function of the banking system in a developing country should be. Might be that some of the rules need to be taught in this context. There is all the argument about all this analysis about cryptocurrency, how this can be used as a part of the toolkit of the policy making. Therefore, all the tools, you can widen the tools a lot, the more credible the overall structure is. If that one is the main, my main, therefore QE in South Africa, I think a possibility is to think about the use of the bank balance sheet. Is not particularly QE might not be particularly helpful name anyway, but the use of the bank balance sheet to absorb part of this capital as an instrument, the possibility of using as an instrument to deal with the fluctuation in prices in the bond market affected by international capital flows. That one is a possibility that I think should be analyzed, because we need more stability on the external side. No instrument in South Africa has targeted the external, the external balance, not the fiscal policy and not the monetary policy. Therefore, you need to find ways in which one instrument, either the fiscal or the monetary, is deal with these external fluctuations. And what are the instruments? Definitely the fiscal surpluses are one, the fiscal positions are one, but the possibility of using the SARB balance sheet to deal with this external fluctuation is something we need to think about, because a lot of people is using it, and it might be useful in this context.
So, Nicola, I mean, this is quite useful. You're moving us into kind of probably the last area that we haven't covered. But just before that, I want to say, I mean, we're watching your Q&A in the chat. We're going to go through another round discussing some of the relationships between monetary policy and the external environment. And then I'm going to ask Matthew to come in and give us some of the questions that you're posting in the chat. And after that, we're going to close the session. So let me, Nicola, maybe I'll start again with you, asking you about, I mean, the external environment is changing, right? In your paper, you cover the external environment and its implications in quite a lot of detail, and you've been referring to that. One of the things which is quite important is this issue between effectively exchange rate volatility and what monetary policy does on the one side. And on the other side, we've got neutral interest rates, or generally policy rates in the global environment and the implications for South Africa. And again, this links to capital flows and various other important measures. How should we think about monetary policy going forward in the context of the external environment? I mean, you've got also this big drive towards climate change issues and climate change investment.
No, I mean, I think these, what we highlight in the paper is, we are not futurologists. Therefore, we cannot imagine how this economy, the world economy evolves. There is a lot of fundamental structural changes that are happening. Therefore, a small country like South Africa, are given. But the fact that this one create an environment, an external environment that will continue to be very bubbly, at least. The interest rate in the US, the real interest rate in the US will be negative for quite a while. In Europe, even longer. The movement of the Fed to an average inflation targeting without defining a time which this average extrapolated or a band bring us in a total different area of what monetary policy is in US, how it might evolve. There is so many uncertainty on the evolution that you have to take the uncertainty as a given. If the world is this uncertain, you might be lucky sometime, like for example we are now. I think now there is a lot of, when we are talking about the revaluation of the exchange rate, this revaluation of the exchange rate because capital is coming in, because there is a sort of commodity prices are going up, therefore it's a good time. Okay, now in this good time, you have to prepare for the bad time because they're coming, can be around the corner. That's when I say, prepare buffer stock. Because the good time is not because we have done something good. It's not because we are growing. Therefore, our exchange rate is not revaluing because people look at South Africa and say, wow, what a great place. It's just because we are a small boat in a big sea and there is a big wave that is pushing us ahead. Then use this. And this is the moment to say, okay, what is that we have a bit of breathing space to deal with our fiscal issue, to build up some of the buffer stock. That's how the international environment, I think, should be considered. Not try to forecast where we are going. Biden might lose, we go back to Trump, you go back a trade war between China and US. The possible scenario are an infinite set. But the possible response of what we should do is not an infinite set. Given this uncertainty, we have to use this moment of calm to discuss, like we do now, what are the issue, but also to make important decisions that will bring us most of all on a path of growth. If you grow fast, then the external uncertainty, it doesn't really matter much. No. It matters a lot when you grow very, very little, because then the uncertainty is what determines everything. Therefore, we need to reduce the importance of uncertainty by increase the growth path.
Can I jump in quickly and just ask?
Yes, of course.
Prof, isn't this exactly what the SARB is doing, though? They have acknowledged that, they never really follow a specific group of EM central banks as to what they're doing, or the Fed, not necessarily neck on neck. They've also acknowledged that ultimately the objective here is to anchor inflation expectations and keep them anchored, even if possibly at a lower rate. And they've also acknowledged that, yes, we've got some breathing room and we've got some space to work with here, but this commodity cycle and the gains we're getting off terms of trade and the current account surplus and all of that, none of this is in their medium-term thinking. This is all just, to use the very popular word, transitory at the moment. Yeah. So isn't this exactly what they are doing, having also introduced the possibility now that down the line, as they try to normalize interest rates to build up some buffer, they also have the option in future bouts of financial instability to step up their bond buying, purchasing in the secondary market. I mean, so, I understand that's what your paper is trying to say, is what else can they do? But just doing that alone, is that not enough? In other words, I guess where I'm trying to go with this is, do you want to open Pandora's box? Do you want to do something which immediately makes anyone know that something is possible? Because you could go back, but once you've introduced it as a possibility, then it's there.
No, absolutely. The paper is partly analyzing monetary policy, but is also a response to some of how people frame the debate, or you can see outside. Therefore, the idea that the bank can be a sort of credit institution that provide money for small medium enterprise. There is a lot of MMT. You have these sort of money monetary theory that people throw it around. It's just sort of the Laffer curve of the left, this word without constraint. Therefore, is essentially monetary policy. Actually, I think it can do very little for these long-term big issues. What monetary policy can do is to provide this anchor and this credibility. In that context, then has got a bit of room of maneuver to deal with part of this uncertainty. I think that is, but the problem when we talk about opening the Pandora's box, like you said, is what I was saying, that your ability to do things unconventional are inversely proportional at the credibility of the system overall, and the acceptance, the political acceptance of the independence of the central bank and the long-term objective of the central bank as the the accepted fact, and that there is no contestation of this role of this bureaucratic institution, of this independent institution that has got a role in this context. And I think this one in South Africa is still not, people is still uncertain for how long the central bank will be so independent. How long how much time we have before, in the impossibility of solve any other problem, people only talk about, nationalization of the bank, all the discussion, and that one I think is the main, is the big constraint on the ability of the bank to do more.
Constantine, do you mind if I ask Mama Casey a question?
No, of course. Please ask some questions.
Don't get too scared here, Mama Casey. I'm just interested because of where you sit and what you do. So from what the Prof was saying, if new things are tried and experimented with, do you think investors or markets, do you think they react better if it's something the SARB has chosen to do or something that government has given the SARB to do? So maybe just unpack those two differences. So in other words, the SARB came up with a decision on the secondary market with bond purchases. That's fine. But I guess where I'm going with this is, in a hypothetical example where we don't have the governor that is currently at the helm, if government puts someone else there in place, I mean, that's a very extreme example. But, just how different would the response be from investors, depending on those two situations?
I was actually, as you're having this conversation about QE back and forth, I couldn't quite remember which central bank it was. But there's a central bank where lawmakers in the middle of the COVID crisis changed the law because they said, oh, this bank should do QE, and the central bank said, well, we can't. The law prohibits it. So Parliament actually then went and changed the law and basically said, oh, now this bank can do QE. And the central bank still refused to do it. The governor was like, sorry, still not doing it. I'm not biting, right? So, within that, you could see how the whole conflict between lawmaking and central banking sort of came to a head for obvious reasons. So, in that instance, it becomes super critical that the central bank is independent, that it acts in a way, in decisions are seen to be, coming from the central bank itself. Because if it becomes a politician's game, then there is obviously going to be a massive erosion of the perception of central bank independence and monetary policy credibility over time, and then it becomes quite negative. So I think it was really, really critical that the SARB in that instance was seen as independent and acting independently. Anything to the contrary would not have been perceived quite as magnanimously or been seen as harmless, as quite as harmless as it eventually was perceived. But obviously, within that context, that assumption of whether this is harmless or not, one of it is obviously central bank independence and where the source of the decision seems to be coming from. But there's other things as well. If the central bank itself is credible, other than whether it's politically influenced or not, if decisions are seen to be evidence-based, they seem to be responsive, they're not an irresponsible central bank. So you can be independent, but if you're irresponsible, it's still going to be a problem in the long run. So all of those things sort of come into the mix in terms of how the market perceives these things. And then also how you execute, how you're seen to be proceeding as time evolves also matters. What I found interesting is also what Nicola said about Chile, and this idea that, the more robust the rest of the macroeconomic framework, the more degrees of freedom the central bank has, the more experimental it can be. So, it speaks to this idea of buffers, it speaks to fiscal policy being more credible, because then it creates quite a lot of room for the central bank to be a bit more experimental in how it executes on various arms of policy. So, you know, if you like the US and you're running basically the funding currency, who cares about credibility? You can do whatever the hell you want, right? But you know, where we sit, you know, then credibility matters a lot, because now you're basically at the mercy of global financial markets for each cent of capital that you get. So there's also that none of these things are fixed, none of these things are static. It's all depends on how all of these things come together.
Thank you, Mamuketi. I want us to go now to Matthew. And Matthew, if you can give us 2 or 3 questions, maybe, I mean, of course, start with one first and we allow the panel to respond. Matthew, over to you.
Thanks very much, Constantine. Yeah, there's been a number of very interesting comments. I worry that some of them have been raised directly with the panel, so aren't available for everyone to engage with. But quite detailed commentary and questions, quite a lot of commentary in terms of the credibility issue, the importance of the issues raised in the paper about the importance of fiscal credibility, in particular with regards to monetary credibility or broader economic credibility. We are starting to run out of time, so rather than go through each one, let me try and synthesize a couple of issues to throw back at Nicola and the panel. I mean, it is a fantastic opportunity. We've got here a kind of leading academic, market analyst and market practitioners, and would be very interested to hear their different views on these issues. The first kind of theme that I'm picking up is this idea of de-risking. You know, how do we begin to reduce the cost of capital within the economy? What is the contribution of fiscal and monetary policy in terms of that? And, you know, we all know the graphs fairly well, but basically what you've seen is since the early 2000s, the average effective interest rate declining until about 2007, and then stabilizing. And, you know, there's a question about whether it's stabilized at a level that is unreasonably high or not fairly high. And if that's the case, how would we go about addressing that in a responsible and sustainable way? The second area of interest seems to be around the impact of fiscal policy and how it feeds through into the monetary environment, how it contributes, especially through what kind of transmission channels it's contributing through. And a question that I have around that is, how do we understand the fiscal consolidation that government has planned and the outlook for monetary policy and monetary policy choices? You know, the GDP numbers seem to be performing fairly well, but a lot of it is being driven on the household sector, consumption sector. The consolidation objective is to retrench a lot of that temporary social support, but also to limit growth in public sector wages. So, you know, thinking about that transmission channel and how that might play through, but also the issue of credibility is quite important. Do we face a Dutch disease situation? I know that we've talked about it a little bit, but I wouldn't mind some quite specific comment around that. You know, and what is the role of the various institutions that we're talking about in this conversation around that? How should we be looking to respond? Lastly, my own question, does any of this matter? With so much global liquidity around, does anyone care? There we go.
Who wants to go first?
I'll happily start by responding to your second one about, you know, what's going on right now with fiscal. I do think that something around expansionary fiscal contraction needs to be brought in here. So in other words, yes, we have to be very careful about how we reduce expenditure in the budget or our austerity plans, if you want to go as far as call it that. But I know Constantine, he's also done so much work here on fiscal multipliers. So pulling that into planning your reduced expenditure helps to reduce expenditure on things that have helped to drive up your risk premium. So in other words, let's use the elephant in the room, the public sector wage bill, as a key example here. Yes, you reduce expenditure on that. And yes, that could take something away from the economy. But at the same time, it's seen as such an input to risk premium because it's been a fiscal issue that's needed to be addressed for so long. I mean, from sovereign rating agencies to, fixed income investors, a lot of people have taken this as a yardstick of political will. So they're bringing in that political economy again. So this is an element of how, yes, you do need to run down expenditure. You can't possibly do it across everything. You need to differentiate between fiscal multipliers as to which items you're running down, and obviously do it in a responsible manner that helps to reduce risk premium and give you more confidence in the economy to hopefully get more private participation in, but not do it to obviously reduce the potential growth that you're hoping for down the line. So maybe I'll leave it there and let someone else respond either to that or the first or other questions.
Viegi, you want to go next? Yeah.
And let me go next. So, you asked a question about dust disease. I would like to hear Nicola's response to this, because to some extent, if you allow fiscal policy to be responsive to any windfall sort of gains from, say, commodities, etc., which is sort of links up, I suppose, to the FX question. One of the ways in which you can do it, which is something that, Treasury was sort of starting to think about and try into the latter part of the 2000s, is to allow fiscal policy to be responsive and build up the buffers that Nicola is talking about. Maybe use like national wealth funds, etc. And in that instance, then you mop up some of the liquidity that you would be getting from these possibly temporary shocks from the external side. And therefore you limit the impact of those shocks on the real economy, and you might then be able to moderate the impact of the Dutch disease in that fashion. And I think it is sort of like where policy was sort of going in the previous dispensation, and now we are here. And I think this also speaks to the whole issue, that you raise, about, does this really matter? You've got a lot of external capital coming in. So all of these things surely are not relevant. And I think, Nicola again answers that question in a similar way to say, because that, or you at least don't know how long this is going to last. You don't know how long the external environment is going to remain supportive. You use this again as an opportunity to build the buffers that you need, so that when the shocks come, as they invariably do, you've got scope to deal with it. And if you think about the macroeconomic dispensation that we had in the 2000s, and starting in the late 90s into the 2000s, and how we then were able to navigate through the GFC, which is much better than a lot of other economies. It speaks to the fact that we went into that crisis with buffers. We went into the current crisis with a lot fewer buffers. And unless we do something in the intervening period, we're going to go into the next crisis. Maybe we won't come out of that one because we're going to go in there with absolutely nothing. So these are, I suppose it comes back to Nicola's point again about that maybe the game is not to be trying to do, it's to be trying to build, buffers so that you become more a risk manager, essentially, versus trying to drive where things are going or how you want things to work out.
I want to answer a bit a different way. South Africa is very peculiar in emerging countries for two things. One, because it's got a financial market that allows South Africa to have access to a lot of capital, a lot of international capital, more than any other emerging countries. In South Africa, because it never suffered from sort of the regional scene of a high inflation, because South Africa never experienced this, is able to borrow a very long term. Therefore, the ability of the governments to borrow beyond the 30 years is comparable to UK. These are two great privileges that are sustained this country in the last 10 years. Because without this privilege, that period would have been worse because we will not have such a great access to international capital that kept on financing deficit for a long time. The fact that we can, it doesn't mean that we should. Doesn't mean that we can base a growth strategy on our ability to borrow. Because we have the technical ability, because we have the historical experience that allow us to borrow. Because these one are privileges that can easily be reverted very fast if we misuse it. And I think that's why it matters. Because the fact that we can have access to international liquidity, the fact that we have been in a situation of large international liquidity for the last, after the global financial crisis, because of the central bank, the QE, it can revert in one day. If the Fed decides that this increase in inflation is not transitory, but is permanent, and move the interest rate from 0 to whatever level, all this liquidity will disappear pretty fast. And what we have, to respond to that, and therefore that the fiscal in relation to Dutch disease or in relation to any of these external we need to build up our strength. That is not only a strength. I come from a country that has done fiscal consolidation for I think at least 30 years. I'm from Italy. Is somebody doubt from my accent where I was from. But my country did fiscal consolidation for 30, 40 years. Always. And actually, if you look at the primary deficit in South Africa, there is in Italy, there is a primary surplus for a long period. But the question is that you cannot do really fiscal consolidation. Fiscal consolidation will not be successful if you don't build up externally the condition for the fiscal consolidation. Therefore, you don't build up the necessary reforms in the goods market, in the labor market, in all the things that Gina was talking about on the infrastructure side, on the network industry, or on if you do increase the efficiency so that you can absorb this fiscal consolidation as a process of transformation of the economy overall. Because otherwise, it become a catch-22. You do fiscal consolidation, the economy slow down, then your GDP go down, and then you have to do more fiscal consolidation. And therefore, it's important to have a plan of fiscal consolidation that is linked to our overall plan or reform of the economy overall. For example, this issue of the electricity market, I think is part of this fiscal consolidation problem, not because of only of the risk of ESCO, but because it's changing the structure, or potentially, let's put always potentially, changing the structure of fundamental market for the growth of the economy. And therefore, there is this element of, what is the make a fiscal consolidation credible is what is the growth plan that is around that.
Thank you, Nicola. So we've got 5 minutes.
It matters. But.
So we've got 5 minutes left. What I want us to do is to, for the next 2 minutes, do closing remarks. And then I'm going to ask Matthew to come in and tell us about the next webinars. So as you give us your final remarks, which should not exceed 30 seconds, it will be useful to tell us what your view is about the inflation target level. Our governor has been making some remarks, and it will be interesting to hear what your view is. So let's start maybe with Mamuketi. This is effectively, you need to be forward-looking here. in your kind of 5 minutes.
I missed the question. I was busy answering.
Okay, so the question is,
question?
I mean, this is effectively we're ending off, and it's
okay.
What I would like to know from you as you're ending off is, what is your view on the inflation target level going forward? And this is in the context of some of the remarks that have been made by our governor.
You know,
which is for a lower target level.
If we have a situation where, so if I look at the situation over the past 10 years where the big trading partners in DM were struggling to get inflation above 0 on a sustainable basis, and we were sitting with an inflation target of 4.5, I think that was more problematic than the situation going forward. So should DM economies succeed in getting inflation, you know, picked up a bit so that it gets closer to the 2%, then 4.5 relative to 2% is not as problematic for me as 4.5 relative to, say, a 0 level. So I think the whole target issue becomes a bit less pressing going forward. So I get why you would want to collapse your inflation target as much as you can, but to my mind, this is probably not the time to be trying to do that, especially when globally inflation hopefully is being reset higher. So I think we've got a bit of time around that issue, and that we should expend our very limited political capital, as Nicola has indicated elsewhere.
Thanks, Ekaterina.
Yes, so I'm going to add a bit here on making the inflation target more explicit. So we have an explicit 3 to 6% range, but we have an implicit point target of 4.5%. And I think a lot of uncertainty being created at the moment is what the actual implicit tolerance band is around that, because it's quite evident it's not 3 to 6% explicit target range. So there could be quite a lot of merit in redefining around the 4.5% midpoint what exactly our new explicit tolerance band is, so we can stop guessing how much inflation the SARB is willing to tolerate.
Thanks, Gina. Nicola?
Yeah, I'm a big supporter of inflation target. It works the clearest it is. Therefore, I think that if there is something, is really to make it more transparent and more explicit. This focal point on the 4.4, try to make much more explicit these choices. See, I'm not sure at this moment is really priority to start a discussion on reduction or the reduction of the target. I think it might put too much emphasis on monetary policy again, in a context in which the emphasis should be on other parts of other instruments. But the governor, I will ask him. I'm sure he's gonna punish me for that.
Well, let's hope he doesn't punish you. But I mean, I want to say thank you to our panelists. I think this was a very rich discussion. I think the one thing that came out very strongly for me is the issue of the effectiveness of monetary policy and the toolkit depends on various other things, and very much depends on what buffers you have. It very much depends on the credibility of other policies, in particular fiscal policy. But I also found the comment from Gina very useful in terms of how she defined credibility. That credibility is not about time consistency in policy, but it is a credibility that comes from the environment around you. And this is political credibility or political support, and it is, again, the credibility of kind of the broader economic agenda. And I think this is the major takeaway for me. I want to go now to Matthew. Matthew is going to tell you the next set of webinars, and we're going to end. Matthew, over to you.
Thanks, Constantine. You've thanked the presenter and the discussants, and I'd echo you, but also to thank you for chairing and managing the conversation so excellently. Also, the attendees who've made very interesting and I think sometimes quite important contributions. There are many issues that have been raised that we haven't really gotten around to. I mean, I'm sitting looking at one question here that we haven't spoken about at all, and it's probably terribly important, saying we have an unemployment crisis in South Africa. And why do we not use some of the central bank tools to target unemployment? There are a whole bunch of other very interesting issues related to monetary, but also macroeconomic policy here. And as ERSA, we're going to have to think about how we can continue to engage with these issues. And my apologies to anybody who feels we haven't been able to engage with the issues you've raised adequately in the compressed time that we have. The institution that I move into, ERSA, is an environment of excellence and independence, which are characteristics that have been very closely protected by all the people involved over the years. And it's greatly appreciated by the community interested in economic research. ERSA has built an important and meaningful contribution to the Economics Academy, but for some time now, we've been looking to move beyond the academic environment and link the academic work with you guys, the community of economic policymakers and practitioners. And this is not a simple objective, but workshops like these are an extremely important opportunity to advance that objective, both in terms of contributing to the debate, but also in hearing from you on what are the issues of importance and very often what your thoughts are or what your contributions on those are. So this workshop on monetary policy is part of a broader program that we're rolling out over the next 6 weeks. Topics that we'll be covering starting again in about 2 weeks and doing it roughly every 2 weeks from there. Recovery policies and labor market utilization, then international perspectives and South Africa's trade policy, climate change and building back. And we are doing this in partnership with IFPRI and the GIZ. We'll be sending out invitations, so please keep an eye on the website and your email for those invitations, but also please look out for the podcasts on these topics. One of the innovations we're trying out with these workshops is to provide a kind of introductory short podcast to prime the issues so that we don't have to spend a lot of time on lengthy introductory presentations and we can focus more on the debate. But Constantine, I've already taken too much time. So, let me just say that we look forward to these future engagements and to hearing from you guys, the community of interested economic practitioners and policymakers, about how we can continue to advance debate and discussion from a point of rigor, research, and hopefully academic robustness.
Thank you.
Thank you all. Goodbye.
Thanks, everyone.